Good afternoon, everyone. I'm Jason Pandak, Vice President in Debt Capital Markets at AmeriVet Securities, former Marine and defense industry professional. I'm joined today by AmeriVet's Head of U.S. Rates, Gregory Faranello, CFA, and we wanted to do a short update on kind of the macro situation and where things look with broad strokes today, this afternoon on April the 8th. Afternoon, Greg. How
Good.
are you? Because it's been a busy, would you say it's been a busy 24 hours or so?
I would say a little busy. Yeah, I didn't get much sleep. Uh, Good afternoon, JP, and thank you for joining. Congratulations on your Michigan win. It's pretty
That
big.
was that was clearly the most important thing that's happened over the last 48 hours or so was Michigan winning the national title for sure. Thank you.
Yeah, so it's been, look, I mean, it's an incredible day. You and I have talked about this. We've certainly written to our clients that things were going to come to some sort of head here in terms of where we go forward. So the ceasefire, very constructive. The markets like it a lot. We still remain very constructive on the economy moving forward. On a global basis, I mean, there are certainly some macro issues that are at play. If you look at the rate markets in general today, if you look at Europe, and they've been moving around the most, you've got some European rates that are down by 25 basis points on the short end, which is a big move. The U.S. is certainly lagging here, but markets like it, and at the end of the day, I think the overall picture remains very constructive for capital market activity and also for the economy, but we're going to need to work through this period of time.
Yeah, that sounds just about right. It's certainly an interesting geopolitical situation. Um, Obviously, there's been a lot of talk over the last 24 hours. I think it's somewhat interesting that it seems like right now both sides are kind of declaring victory, which is interesting. I'm sure there will be some back and forth on, the specifics of the 10 points that were agreed to, or at least proposed and tentatively agreed to. It sounds like that's going to start Friday. Um, it it's certainly very interesting. I'm curious what you think in terms of the broader market structure and as we look at the overall, European versus United States in terms of their economic policy. There's been a lot of talk about NATO. There's been a lot of talk about how NATO has or has not responded. But I think one of the things that's interesting is, there is a European Central Bank, right? There are a lot of moves like you just talked about. How do you see, the Fed? Do you think the Fed and the European Central Bank will be working in lockstep like they traditionally do, or are they going to have to defend their own currencies?
Yeah, I think yeah, that's a good question. I mean, I think it's defend your turf at this point. So we started to price in the US, we started to price in rate hikes, and we're pricing that in a little bit in Europe as well. I mean, they're clearly geographically they're closer. And I think if you listen to the president, that's kind of what he's saying. Like you guys need to defend your own turf to a certain extent. And we've done our part. With regard to central bank policy in general, my personal view is, and we've written this ad nauseum, higher rates are not the answer here. This is a supply issue. It's a flow issue. We're starting to see ships go through the strait, and that is the end objective. And if you look at things here in the US, you look at oil prices, I mean, the president doesn't need oil prices higher from here. He needs them lower. And that's been his policy. So, from a central bank perspective, higher rates are not going to be the answer here. There's no question in my mind. It's going to make it worse because my view is the higher energy prices, ultimately, it comes out of growth. There will be an inflation component to that. We'll get inflation numbers over the next couple of days here. And I think the data is going to be, it's going to be pretty distorted over the next couple of months between the government shutdown, the partial shutdown, now all these other dynamics. So we're going to need a little bit more time, but I think markets are going to see through that. But central bank policy, higher rates, it's not the answer here, in my view.
Yeah, I definitely agree with you on that. And I did want to just talk with you a little bit about data. And we did have a Fed chair, Chair Powell, well, we still do at this point, who was very specific about saying we want to be data driven as the Fed. You're talking now about there may be a lag in good data because there will be distortions over the next, couple readings because of the government shutdown, because of the situation, the war here in Iran, which, we all hope is concluding and wrapping up and things will, more or less return to normal. With a new Fed chair in, do you think that'll be a challenge for them in terms of reading the data? Will they have to wait longer or, is it, I'm just curious what the risks are there with distortion of the data. Like how much can you trust these readings?
I think short term it's a little difficult. Kevin Warsh, I think ultimately will be confirmed. It's a tricky process because you've got some legalities now going on with Chair Jay Powell. He's unhappy about that. You've got some elected officials that are not terribly thrilled with that as well. So he will be confirmed. My view on any new Fed chair coming in is they're going to be objective, right? They're not just going to come in and start lowering rates if they can't lower rates. So if the inflation data, which we expect to be a little bit elevated in the short term, they're not going to just come in and lower rates. So if you look at the curve, if you look at the forward curve, if you look at SOFR out through the end of 2026, it seems like we bottomed a little bit. We're starting to move higher in price, which means lower in yield. So we're taking the froth off a little bit, but I expect any Fed chair that comes in, and it will be Kevin Warsh, to be objective in terms of looking at the data and making the right decisions. And I firmly believe that. And I firmly believe in an independent Fed at this point as well.
Gotcha. Clearly very important. And certainly markets, I think, have um, spoken on that regard, right? Right. In terms of the amount that they value having a strong and independent Fed uh, that is not being politically driven. Um,
It's
so,
it's 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 an important process now too, because you've got all the geopolitical stuff going on at the same time. You've got a U.S. economy that really is poised to grow above trend. We'll see how that works out short term with all these distortions, but getting a new Fed chair in place, I think, for the country is really, really important right now, given everything else that's going on.
gosh, absolutely right. And I think, when we look at it from our issuer's perspective, our client perspective on the issuer side, I think that stability is key. And I think that's one thing that I did want you to talk about. Obviously, we've talked about, there was some pricing in of cuts, then there was some pricing in of rates. Just as you look through, we've got a little more than 6 months left, so maybe 8 months left here in the year. When you look at the end of 2026, where do you think we'll be in terms of rates?
We could sit here all year on hold, and we've sort of outlined that scenario. My personal view is I think the U.S. economy needs lower rates in general. We follow the 10-year very closely, 4.25. I mean, we're still in the range. If you look at the last 5 years, we've been 3.25 to 5%. We're still in that range. Mortgage rates. I mean, I think the rate structure in general needs to come down, but if market dynamics don't dictate that, they're not going to come down. So, to be objective, some of what the president wants to accomplish here in terms of lower rates is going counter to what's going on abroad right now. So, and he's well advised, he understands, but the Fed could sit here for a while. I mean, there's no question about it, depending on the data. Now, we had a good employment number, which is good. We're transitioning the economy from the public sector to the private sector, and you could see that in the numbers. So, that kind of keeps the Fed on hold. If you take the employment data that we just got in conjunction with the inflation data, which is likely to come and be elevated, The Fed has nothing to do here at all. And so, but we continue to keep a very close eye on the 10-year because ultimately, I think that's really what it's about right now. And we're still, we have favored adding duration in and around, 440, scaling in at least, not going all in. And, we're back toward, 425. So we're still historically, if you look at the last 5 years, we're still well within the range. So, and I would, for clients, I would say keep a close eye on the 10-year. It is the bellwether globally from a capital perspective. You go back to the pandemic, you look at what rates were doing back then, the US Treasury market was telling us that something was coming. And right now, the US 10-year is telling me that things are, they're not great, but there's no alarm bells being set off.
Gosh, I think that's certainly good to hear, especially over the since the last 3 or 4 weeks, whatever it's been here with all that's going on. And so I think where it makes sense to end is as obviously we all watched the news. Everyone's excited that there was a ceasefire deal in the works, or at least tentatively agreed to last night. Obviously, the politics and the geopolitics of the Middle East are more complex than certainly we can cover in this 15-minute chat. But if the ceasefire doesn't hold, because and again, it's very hard to tell. As I sit here in New York right now, it's very hard to tell exactly what's going on. But there's reports, you know, Israel's attacking Lebanon or vice versa, and that was part of the deal. If talks break down, do you see us going, back up in terms of oil? Or is that, I'm just curious what you think is the big risk there. And is it possible to separate these risks out? I assume the president will try to do that, but I'm curious how it's all intertwined.
It's a little difficult right now to make that assessment. I think markets are the moves that we're seeing are, from a standard deviation standpoint, are things that we haven't seen in a long time. So whether you look at European rates, whether you look at oil, I mean, these are really, really outsized moves. If the ceasefire doesn't hold, yeah, I mean, you would expect oil to move back higher. The implications for rates, I think, are a little tricky because that correlation has been moving around. I mean, there was a period of time where, oil was moving higher and rates were completely correlated to that, based on the fact that I think that the market perceived inflation was the bigger problem, and then rates were moving lower and oil was moving higher. We've written to this about clients because ultimately it becomes a growth story. So if the ceasefire doesn't hold, yeah, I mean the moves that we're seeing today, I think it's fair to say that we'll reverse back the other way. But we're not
Gotcha.
we're not
Yeah.
there yet, and I'm very hopeful that this ceasefire is going to hold.
I am as well. And again, there's plenty of experts that have spent literally decades trying to understand all these things. I'm certainly not on their level and level of understanding, but obviously hoping for the best and hoping that the different parties can agree on some things. Because again, I think the stability is going to matter the most, and we do have plenty of things that we need to do here at home in our own economy, and I know our clients have their own priorities and things they want to do and bring to market. And Greg, I do want to say thanks very much, and I want to remind all of our clients that Greg is available at any time for a one-on-one discussions in terms of macro environment and things that are going on in the world, specifically around the rates, and just speak with your coverage person, and we'll get that all set up. So, Greg, thanks very much. Really appreciate you taking the time.
Thank you, JP.